How to choose stocks to invest in, a beginner's guide. Just recently, I was chatting with my friend Brian, who had $100,000 in savings and was asking me about the best company to buy stocks. My conversation with Brian inspired me to make this video here. Thought it might be useful for you. The truth is, there's no magic formula for investing in stocks. Paying for a $1,000 online course won't help either. However, I'll present to you some true strategies that can help you tip the odds in your favor. Today, I'll be walking through with you some of the key factors and metrics to consider when evaluating a company, and I'll be sharing with you some of my personal strategies for finding stocks that have the potential for long-term growth. This is the video that I wish I'd seen when I started investing. So before we dive in, hit that subscribe button if you're finding this useful. The first rule is to stick to what you know. Don't be tempted by the latest stock market fads or the newest trending company. Warren Buffett, one of the most successful investors of all time, warns against investing in something you don't understand. So let's say you love coffee and frequent Starbucks every day. You might consider investing in the company because you understand their business model and enjoy their product. Or let's say you're a fitness enthusiast and a regular customer of Nike. You might want to put your money in Nike because you understand their brand, their products, and the fitness industry as a whole. This understanding will help you make better investment decisions and set you on the path to financial success. Once you've selected a company, you need to make sure that their economics are solid. Buffett recommends thinking like a farmer. If you're buying a farm, you want to know how much land you're getting, what crops you can grow, the expected revenue per acre, and the cost of running the farm. Similarly, when you invest in a company, you need to know their revenue, expenses, and free cash flow. It's safe to say that you're not just buying a stock, you're buying a piece of that company. So make sure you're investing in solid companies with good business models that you understand and are passionate about. In the end, it's the sound financials of the companies that will drive your investment returns over the long term. The next step would be to do a financial analysis. I like to look at the numbers first to determine if a company is financially sound. If the numbers don't add up, it's best to move on and look for another company. Think of it like trying to choose a restaurant for a special occasion. You want to make sure it's worth the price and time. So you check the menu, look at the prices, read the reviews, and see if the ambience matches your expectations. If it doesn't meet your standards, then you move on to the next option. A quick search on Yahoo Finance gives me unbiased and comprehensive information about a company's financial position, which I recommend you look at. So first, let's analyze the balance sheet. I know it sounds boring, but trust me, this is the real deal when it comes to determining if a company is suitable to invest in. The balance sheet is the financial report that gives you a snapshot of the company's financial standing at a particular time. It's like a report card that shows you how much a company owns and how much it owes. Imagine owning a car or house. These are your assets, but you have a mortgage or car payment or car loan to pay. These are your liabilities. Assets are classified into three main categories: current assets, long-term assets, and intangible assets. Current assets are the ones that can be easily turned into cash within 12 months, such as cash, accounts receivable, and inventory. Long-term assets are those that the company intends to use for more than a year, such as real estate, equipment, and investments. Intangible assets are those that are not physical but have value, such as patents, copyrights, and trademarks. Liabilities can be divided into current and long-term liabilities. Current liabilities are those that must be repaid within a year, such as accounts payable, taxes, and short-term loans. Long-term liabilities are those that are due in more than a year, such as bonds and mortgages. Let's break down Tesla's balance sheet to see how this concept applies to them. Tesla, as we know, is a company that designs, develops, manufactures, and sells electric vehicles, energy storage systems, and solar products. Looking at Tesla's balance sheet, we can see that their total assets are around $62.5 billion, which is broken down into three categories. Their current assets include things like cash and cash equivalents, accounts receivable, and inventory. Longer-term assets include property, plant, and equipment, as well as investments. Tesla also has non-tangible assets like goodwill and other intangible assets. Now to look at the other side, on the liabilities side, Tesla has both current and long-term liabilities. Their current liabilities include things like accounts payable, accrued expenses, and short-term debt. Their long-term liabilities include things like long-term debt and deferred revenue. Determine a company's financial health. You can use the current ratio, which is the total current assets divided by total current liabilities. If the current ratio is less than 1, it means the company may have a difficult time paying its short-term obligations. On the other hand, a current ratio of more than 1 indicates that the company can pay its debts in the near future. Now, let's do a simple calculation here to see how Tesla's current assets compare to their current liabilities. Tesla's total current assets are around $82.3 billion, while their total current liabilities are around $26.7 billion. If we divide 82.3 by 26.7, we get a current ratio of around 3.0, which is well above the recommended threshold of 1.0. This means that Tesla is in a good financial position to meet its short-term obligations, as it has more than enough current assets to cover its current liabilities. This is an important factor, an indicator of the company's financial health, as it shows that they have enough liquid assets to pay off short-term debt that they owe. The second document that's important to analyze is the income statement. The income statement is like a short story of a business's financial journey. It starts with the revenue, which is the total amount of money the business has taken, and ends with the net income, which is the money that the company makes after all the expenses have been subtracted. Think of it as a roller coaster ride, with revenue as the initial climb and the expenses as the drops and turns that come along the way. Every business has these expenses, the unavoidable cost of operating and generating revenue. I like to pay attention to the profit margin. Investors and analysts use a simple calculation: operating income divided by total revenue times 100 to determine the operating profit margin of a company. Ideally, we look for an operating profit margin above 15%, which indicates that the company is generating sufficient profit from its core operations. Tesla's current operating profit margin is 15.41%, which is at par with the ideal benchmark. Apple's profit margin currently stands at 24.56%. Both of these companies are safe to invest in, as their operating profit margin is above 15%. The last, very important document I'd like to look at is the cash flow statement. This statement reveals how much money is flowing in and out of the company. Naturally, we want to see an upward trend in free cash flow year after year, and lucky for Apple investors, that is the case. But not every company can boast such a consistent increase in their cash flow. Free cash flow is a valuable metric, as it indicates a company's potential and has three primary purposes: debt repayment, dividends, and share buyback. A strong free cash flow is a positive sign for a company's future and could indicate it has outperformed the market over time. Once you have a handle on the basic financial statements, it's time to dig into other metrics. I like to view the price-to-earnings ratio, or PE ratio. It's commonly used in the stock valuation and is calculated by dividing the current share price by its earnings per share. A high PE ratio means investors are anticipating future growth, while a lower ratio may indicate undervaluation. However, to accurately evaluate the PE ratio, I like to compare it against similar companies in the industry. For instance, tech companies typically have a high PE ratio compared to consumer staples. The bottom line: it's not a bad rule of thumb to filter out companies with a PE below 10. However, if a company is not profitable, then the price-to-sales ratio can serve as a benchmark. This metric is calculated by dividing the current share price by the sales per share. Growth companies often use the price-to-sales, or PS, as the alternative to PE ratio. If the price-to-sales ratio is lower than a profitable company in the same industry, you can consider it an attractive investment opportunity. Lastly, you want to determine whether a company has a competitive advantage. For example, a long-serving CEO is usually an excellent indicator of a company's stability. A CEO who has been with the company for a long time has likely weathered many storms and navigated through various challenges. Such a CEO can bring a wealth of experience and knowledge to the table, which can be invaluable in terms of decision-making, strategic planning, and execution. Besides, a long-serving CEO is likely to have a deep understanding of the company's culture, values, and history, which can be a source of competitive advantage. I hope this video provided you with valuable awareness of how to choose the best stocks. If you have any questions, put it in the comments section. And if you found this video helpful, hit the like button and subscribe to the channel. I'll see you guys in the next one. Peace.